The United States and its European allies are discussing a ban on Russian oil imports in the latest attempt to punish Moscow for its incursion in Ukraine. Europe is heavily dependent on Russian gas and a bit less dependent on its crude, but, according to unnamed sources close to the talks, European governments have become more willing to sanction crude exports, Reuters reported earlier today.
If the U.S. simply imposes an import ban, that's a sort of a big deal, but it's not as big a deal on the global market because really the U.S. only imports a relatively small amount of oil from Russia. If the EU comes along and does something similar, that's a big deal because although the U.S. and the EU are not the sum total of Russia's export market, combined, that is a big export market for Russia. That's going to have a big impact.
The United States is said to be in very active discussions with its European allies about banning the imports of Russian oil, U.S. Secretary of State Antony Blinken told NBC.
The actions we've taken to date have already had a devastating impact on the Russian economy. But we are looking, again, as we speak, in coordination with allies and partners, at this prospect of banning oil.
Blinken added, however, that the goal would be to maintain a steady global supply of oil despite the ban. U.S. Congress is working on its own set of sanctions targeting Russian oil, even though the United States imports roughly 200,000 barrels per day of Russian crude and about 500,000 barrels per day in refined products that may be difficult to replace because of sanctions that are already in place against Venezuela and Iran. Analysts are warning that a ban on Russian oil would push prices even higher than they already are. And they are high.
We're running the risk of taking 3 or 4 million barrels a day out of the global market relative to Russia. And so excess global capacity, if that happens, basically goes to zero, or if there is such a thing, a negative number, which in turn means prices basically have to go to a level to ration demand. So there is no ability to step into the market from a supply standpoint to really manage the loss of what could be a significant portion of excess global capacity.
Analysts have suggested that oil prices could rise to $150 a barrel in the short term, putting further pressure on global economies, resulting in increased inflation.